Hello friends! In this video, we will talk about the best price action patterns and their logic. So friends, from my experience, I have selected the best and most effective price action patterns that can be used in your trading. But before we use them, let's briefly review or familiarize ourselves with how a candle is formed and what a fractal is. So, friends, in front of you are Japanese candlesticks and how they are formed. Essentially, Japanese candlesticks serve as an indicator for price fluctuations over a certain period of time. Let's look at this with two examples, a bullish candle and a bearish candle. The base of the candle is called the body. Here it is in the form of a green rectangle. So you see two sticks, one at the top and one at the bottom of the candle. They may or may not be present on the candle, but the most important thing we need to understand is that these two sticks are called shadows. The shadows of a candle indicate the price levels that were reached during its price action fluctuations before the moment of closing. So, the opening point, the price makes some fluctuations. And the closing point, as a result, the candle is drawn approximately like this. Follow the mouse. This is roughly how it works. In the case of a bearish candle, it's the same, but in reverse. I think you will have no trouble understanding this. So, let's move on to what fractals are. Fractals are also a kind of indicator that often repeats. By the way, I would like to remind you that our market is fractal, which is why we can determine the future price movement based on history. The moment you see a fractal in front of you that consists of 5 candles and 3 candles, bullish fractals, and bearish fractals. The essence of these fractals is as follows. If we are considering a bullish fractal, then the high and low of the subsequent candle must be below the previous one, up to the midpoint, that is, up to the third candle in the case of a 5-candle fractal. And after the third candle, the subsequent highs and lows of the following candles should be above the previous ones. The same applies to fractals made up of 3 candles for bullish and bearish candles. Now, let's discuss the most effective candlestick patterns of price action. Essentially, they all represent the same market movement, but in different forms and manifestations. Let's dive in. So, the first pattern is engulfing. At the top, you will see bullish options, and at the bottom, you will see bearish options. Engulfing occurs in the market when the second candle completely engulfs the body of the previous one and extends beyond its boundaries. The same goes for the bearish candle. The next candle is the hammer candle. It can be characterized as follows. It has a short body and a long wick on one side. This is how a bullish candle looks, and this is how a bearish candle looks. The next pattern is called rails. The main thing to know about this pattern is that it has very short shadows, and the bodies of the candles are almost identical. In both cases, they are the same. And the last pattern that I use in my trading is scissors. This is quite a rare pattern, but it is also quite effective. It looks something like this. All these patterns that we have just studied are reversal type patterns. We also have patterns of uncertainty. They are also very effective, and their common name is doji. So friends, why are all these patterns essentially the same movement in the market, I will briefly explain the logic. So, for example, let's analyze each of these patterns. Friends, let's start with the engulfing pattern. In this case, the price action report starts with the first candle from the moment it opens. Let's mark this point. We will also mark the global minimum of these two candles. It will be located at this point. And let's mark the global maximum of these two candles, as well as the close of the last candle. So friends, it turns out that if we combine these two candles into one, we would get the following figure. And as you can see, this is essentially our hammer. In fact, all these candles are hammers. Let's break this down using the example of rails. The logic is the same. We mark the base of the candle, and we mark its global minimum. And we note the closing of this candle. In this case, we basically have the same candle. The same goes for the bearish variant. In the case of scissors, it's all the same. The logic remains identical. So, friends, now we understand that essentially it is all the same movement, just in different formations and in different forms. Friends, when it comes to doji, we will directly analyze it using real trading examples. Friends, I almost forgot. Why are reversal patterns in price action so effective? It all comes down to the fact that indeed unique levels of support or resistance can appear in the market. These candles indicate a certain struggle at the moment when the price approaches them closely between sellers and buyers. And when the price approaches certain levels of support or resistance closely, for example, if we analyze the buyers, their strength will gradually be exhausted in attempts to break through this level. As a result, a long shadow of the candle will be formed. And if this hammer pattern or those we studied forms, it can be concluded that the bears will take control. Friends, speaking in the language of a Spartan, these long candles are simply the places where the market often removes liquidity. If these places are indeed truly at the peaks of the market, that is, at the local market minima or maxima, now let's examine these patterns with examples from real trading in real conditions. So the most effective conditions under which it is worth using these patterns. Firstly, these displaced patterns must be located at local extremes of the market. In this case, as you can see, at certain peaks or troughs. The next thing you need to know is that patterns, when at peaks or troughs, must essentially form a specific fractal. As you can clearly see here, here, and here in these three places. Let's talk a bit more about this fractal. This is also a fractal. At the moment, my time frame is 4 hours. If we consider this situation on a daily time frame, it is likely that it will resemble a similar situation with a fractal. Keep mind, do not forget. And the third condition for the most effective use of these patterns is that they should form immediately after some market impulse. A strong market impulse is desirable. Here, in all the cases presented, you can see certain market impulses. The first step is to begin. Then proceed to the second step. Finally, complete the process with the third and final step. Fourth, it is generally best if market impulses are expressed in the form of long-tailed candles, 1, 2, or 3, because these candles create imbalances in the market. Why are these long-tailed candles so effective? They are called imbalances or fair value gaps. We will discuss this in the next videos. And now I'll explain briefly. Let's take the volume profile indicator and simply measure the trading volume in these candles within this range. So, the main feature of these switches is that they simply create price gaps in the market. In other words, the price that simply passed here did not trade at its true value. Therefore, it is likely that the market often tends to frequently return to such switches. That is, if you see the formation of certain pattern formations, or corridors where you can use this strategy. Friends, now let's talk about the doji. This is a figure of uncertainty. This means that at some point the market could not decide where to go. Often this figure is best used after certain market impulses. For example, as you can see on the screen here, after you have observed that the market has formed this figure, be sure to wait for the formation of the next candle. We need to act completely, following all our rules. In this case, we have a market impulse. It is a local extreme of the market, and we need to wait for a fully formed fractal. That is, we need to wait for the next candle that will confirm the market reversal if it forms. So, for me to trade this pattern, the next candle must be bearish, and it should close below the minimum value of the previous candle, which is the doji. Now let's see how the market reacted further. In this case, we see some slight consolidation. We had a drop, but the candle did not close below. It only left a slight shadow. Accordingly, in such moments, it is better not to use the doji figure of uncertainty, because the market is unlikely to reverse and go down. Let's see how the price behaved afterwards, and we can see that it simply continued its movement further. Friends, there are also two more situations visible on the screen. The second one, often, if you find 2 or 3 doji formations, it will be a very strong signal that may indicate a market reversal, as it happened here. But in this case, we need to switch to a smaller time frame and look for a better entry point. So, friends, this is the first situation. And in this case, if I switch from the 4-hour time frame to the hourly time frame, we will see that this is exactly where we could enter a trade. So, if I were to enter a trade here right now, it would be quite a good trade. As we have a fractal formation coinciding at the same time, we also have a reversal pattern, specifically a double doji pattern, and we have liquidity taken from the previous touch. And the last factor is that the candle on the hourly time frame closes above our doji. This means that I could enter a trade right at the close of this candle, placing my stop loss below the minimum of this doji, and I would set my take profit based on the market. In this case, I see a good level of liquidity here that the market subsequently removed. Here we see a certain cluster. We will talk about this in the next videos. So, we would have had quite a good trade. The second situation is similar, but in this case, we only have one doji candle. In this case, I would act as follows. To enter a trade, I would wait for the subsequent candle to close above, forming a kind of fractal, and only after that would I consider entering the trade. In this example, my entry point would be based on that candle. As always, I set my stop loss below the minimum and my take profit at the liquidity level or based on the market. Friends, I also have a couple of trades in real market conditions. Here, I will use the hammer pattern. Friends, I would also like to remind you that these reversal candlestick patterns are best used in conjunction with other technical factors. In this case, we have a triple touch figure. So, we have two touches, and with the third touch, we remove a certain liquidity from below. In fact, at this point, one could already enter a position, as this is quite a strong signal, but we can wait for a complete fractal formation, meaning the next candle that will form the fractal, and then enter the trade from there. Let's see what happened next. So, we see that the candle closed above here. We can enter a trade here or enter a trade here. It's up to you. Set your take profit based on the market. For example, in this case, you can split it into two parts. A good exit point is generally the initial starting point of a market impulse, which in this case was right over here, or some significant market highs, like here. Let's see how the price behaved afterwards. And with one market impulse, it covers and closes our trade in profit. Friends, here is another market situation. There is quite an unclear fractal here. However, if we switch to a higher time frame, specifically a weekly one, there might be a good fractal here, and we could possibly enter a trade. However, I sometimes just skip that. Also, in the next situation, we have a double touch figure, we have a reversal pattern, and we are waiting for the formation of a fractal. So, a fractal was formed here, and this is where we could enter our position. Everything is classic. I set the take profit at the beginning of the market impulse. Now, let's see what happened next in the market. The market formed a triple touch. But note that our trade was still quite good because it indeed removed the remaining liquidity here significantly. Therefore, we shouldn't worry too much about the fact that it might indeed be removed again later. That is, the price could have dipped just below our stop loss, allowing the market maker to simply take liquidity from us. So, let's check if our price reached the take profit. Yes, our price reached the take profit. Great, the trade turned out to be good. That's all for now. Don't forget to subscribe to my channel, where I share my trading ideas and my views on the market. You will also be able to see how I manage my investment portfolio and redistribute profits. I do all of this completely for free, so you can move along with me.